Hey folks, this is a mashup of Business Defined and CFO chat. The banking season is still upon us, and Standard Chartered has just released their earnings with a dividend on steroids. I'm pleased to have the CEO and the CFO, that is Kariuki Ngari and Chimutai Murigo. Karibuni sana.
Asante.
Thank you. And congrats on the numbers.
Thank you.
Thank you.
So my immediate thought when I saw such an uplift on your dividend, the payout is solid at about 86% by my math. The quantum itself is very good. The dividend yield is neck to neck with infrastructure bonds. I thought, wow, I was expecting a lot more conservative on the final dividend, especially given the matters we have before the corridors of justice on the pensions case. Let me start with you, Kariuki. How do you think about that?
I mean, first of all, we're excited as well. We are very happy to give the shareholders a good dividend. And as we analyzed earlier today, and CFO has talked about it earlier today, when we make money and we don't need to retain it based on what we are seeing as an outlook, then we give it back to the shareholders. So we are always excited about that. One of our key stakeholders are shareholders. We always look at. So we look at that. On the other matter that you mentioned, obviously we are a bank that looks at that relies on professional advice. We've got a team of advisors that help us, whether it's on the legal team, on the matters of the case, and how we're going to take this forward, but also on how we do provisions. There's a very clear standards. The standards are very, very clear in terms of when you make a provision. It is very, very clear. And unless those standards are met, then you cannot make a provision. Even your advisors cannot advise you to make the provision. So that's how we approach this matter.
And maybe that's where Chimutai comes in on the provision side. How are you treating this, Chimutai?
What I would say is accounting is dynamic, and we do look at judgmental, complex issues in line with the standard IFRS 37. So it's very clear when to provide, what are the thresholds. As the case is still in court, and with the legal advice we've gotten, we still disclose it as a contingent liability.
Okay. Kariuki, when I looked at your income statement, I thought the good performance notwithstanding, when I look at it from an interest earnings perspective, I thought from your local currency book, the bank was a bit too conservative. You could have extracted a lot more return from that. Do you feel on the LCY side you could have played a lot more aggressive, unlike what you did?
We play what is available. You know, we do not create the assets. We look for clients come to us when there's a business need, and we solve for that business need. If you look at last year, and this has been coming out from the central bank statistics, credit growth is very subdued. Yeah. It is very, very subdued, which tells you that the economic activity is not as it ought to be. So that's a reflection of that. And a subdued economic activity environment means that then you cannot be able to, there are not that many lending opportunities. However, we are a lot more optimistic about 2025 in an environment where the interest rates are coming down, inflation is in the central bank target range. That means there could be a lot more economic activities. And then we can play a more active role in that space.
All right. And Chimutai, the second leg to that question is, were you caught in a bind between the concern that you could tip off some of your customers onto the NPL side in case you decided to go aggressive on the retail side especially?
No, I think Kariuki has covered it really well, because of course the clients also do their own judgments and come to us. But coming to that, when you look at our CIB business, the tenor of the loans are short, and really our clients churn that in terms of working capital, etc. So we did see our clients still continued utilizing their limits for working capital. Yeah, but obviously with rates coming down, that should reignite some demand as expected.
All right. Speaking on rates coming down, there seems to be an industry consensus that we need to rethink the risk-based pricing model framework that exists currently. And I'm curious, and I'm asking every bank executive that I sit with on this full year earnings, what shape and form do you see the successor, if I could call it, take? Because when we came into the current regime, the issue was we need to have a model that reflects the cost of funds in the market. It looks to have misfired a good one, given what we saw last year. And secondly, in August 23, the central bank introduced the corridor anchoring on the interbank. And the whole idea was transmission. So where's the missing link here?
That's it's something that we're working together as an industry. This was new to the market, and last year the interest rates were going up. This year, from the end of last year, interest rates are coming down. You've got to have a model that is able to respond to those dynamics, both going up and both coming down. And it's very difficult to just use one criteria to determine the rates. It cannot just be the cost of funds, because that's not necessarily the only thing that affects the interest rates and the cost of credit. There are other factors in there. So how do we factor in all those factors? And most importantly, if you remember, the genesis of risk-based pricing was, how do you rate an individual client when they come to you? So you take their risk and you're able to price it accordingly. There's still some work to be done. I would say it's very early days yet. I would not say that I would not argue that anything has misfired yet. It's work in progress, and then in the fullness of time, we shall have something that works for Kenya. It works for the financial system, and most importantly, works for the economy of this market.
Yeah, I think, Julian, these are models, and you backtest and see how models react to circumstances. So obviously, we are going through that phase of revisiting the models, and the ideal model obviously is the one that responds to the monetary policy, transmitting the policy, and obviously resulting in optimal outcomes to clients. Yeah.
So allow me to ask this question, because I've asked this before, that would anchoring a unified base rate across the banking industry to the repo market yield better results?
The repo market has developed a lot, obviously, through the corridor. It could be one of those ones that is looked at, but you probably have to look at other factors, as Kariuki said, to come up with a model that then captures everything.
Okay.
Yeah.
Two metrics in your numbers which were really outstanding for me and prodded me into one question. Let me start with your asset quality. Your NPL ratio at 7%, it looks like you're operating in an entirely different market, CEO. And I wonder whether it's a reflection that, one, as far as skin in the game is concerned, maybe you need to take a different posture compared to what you have currently. What would be your sweet spot?
Or you want it to be higher? I think not. It is what that number probably is not telling you. It's a result of a lot of work that has gone into getting that number, because that's an outcome. If you look at previously in prior years, probably 2016, 2017, we are way in the double digit, above 15%, if I recall. And a lot of work has taken to identify what has got us there and what is the right place to be at. So we as a bank, we don't say this is our target, we want to have an NPL of 7%. It's looking at the assets that you're putting on your book, the quality of those assets, and then how you monitor those assets. Because if you don't monitor them when they're in your book, eventually something can go wrong. So there's a lot of testing that gets done, that if this book or in this sector, if we're in this sector and things are operating normally, what does it mean? Stress that sector. What is the worst case scenario? Based on the worst case scenario, then you decide this is how we're going to operate in this environment. This is the risk appetite, and this is the risk appetite that we'll take. So you have to take all that into account. So I wouldn't say that you want to operate at 7 or 10%. No, it's a quality of the asset that comes to you, and based on our risk appetite, we would like to keep growing our assets. We would like to keep growing our assets and delivering return to the shareholders. So you don't want to go to one.
That was the second leg of my question, Chemutai, because I was going to flip in and ask, surely there should be a level below which you'll start asking yourself, are we not really in the market? What's really at play here? And that's what I'm driving at Chemutai.
I think Kariuki has really touched on the process and how we look at risk, forward-looking, stress testing, doing early reviews and all that. So I think we've become quite good at that. Obviously, we want to lend to our clients, and you could see there is room there is room to take on more assets. And we believe that clients in 2025, particularly as rates come down, I think clients will take on more lending. So that will work for us. Yeah.
And the second one was on the efficiency. I mean, I'm impressed by the cost-to-income ratio, but again, the same question that I asked myself is looking at where the industry is playing vis-a-vis where StanChart is playing. Would a certain level being attained begin signaling you that maybe we are not investing enough or deploying a lot more out there than we should?
If you look at our investment and we look at our numbers, I believe we are investing sufficiently. If we look at, I was looking for the last 2 years, for instance, we put in about 600 million to cybersecurity. So we are investing. It's technology. As our anchor is technology. Yeah. That's our strategy in terms of everything that we do is digitally led. So a technology helps you save a lot of costs. So you're not, for instance, if you look at the branch network, we are not using the physical branch network to bring you new business. A lot of our new business today is being done digitally, whether it's bringing new clients into the bank, whether it's on the investment options you talked about. All that is being done digitally. Mm-hmm. And as our clients become a lot more tech savvy, then they will use technology a lot more. So we are investing, but we're investing in the sectors that can lead to a lower cost income ratio.
Okay. So essentially, sorry, time.
And you saw our total cost for 2024 was 20 billion, 3.6 was investments, same as last year. So we, as Kariuki said, we're still really investing into the business. In addition to what he's talked about, investing in our certification of our wealth experts to support our affluent business. So we're still investing.
Okay.
Yeah.
Okay. As the earnings for the industry stream in, and as we dial down our conversation because of time constraints, one of the things which I've noticed is that a lot more banks are taking a piece of the pie when it comes to the G2G government arrangement. Initially, we had an anchor bank which is increasingly ceding its share there. And I'm curious as to your exposure on that side.
The way we are playing in that space is on we'd call it the second line, where we are, remember all this G2G, there's letters of credit have to be confirmed. Yeah. And that is where our network comes in terms of these banks, they're mainly the UAE, we have a presence there. So we are playing in that space, only that we play it differently. That's the approach that we are taking, that any of the banks that is going to take that space will need letters of confirmation, they will need support, and as a bank, that is how we come in. And just to add something, Julian, which is important, is that in a bank's earnings, it's not always lending that brings in the income, as our numbers attest to it. Sure. So when we see the 40% NFI growth, it's very deliberate. That's what we would like to focus on as well, because we believe there are a lot of opportunities that we can play in that space and continue making sure the bank is growing. So our focus is not always in the lending space. We also look at the NFI, and hence our big push on the wealth management business on the WRB side, or transactional services on the CIB services, how we play in the market space. So we are very, very focused in ensuring that NFI growth is continuing because of the transactions that are happening and the deals that we're helping clients solve for them. Then that's another place that we're playing at. I wanted to ensure that point is not lost.
And actually, that was one of my sweet spots in your earnings, because it looked to me like a hedge, if I could call it, to the sort of environment we had last year. And maybe Chimutai can give us a lot more color here, just how it helps you balance out your outcomes in an environment where interest rate growth has been really constrained.
Yes, I think capital lending, etc., is very capital intensive. So we have to balance. To be able to give a strong return to the shareholders, we have to really balance how we optimize the capital that we deploy. And so we really focus on different products. Some of the products tend to be capital light, some are capital heavy, but at the end of it, you are serving the client. So if you can achieve a blend that is optimal, then the quality of your returns, given the cost of capital, is then optimized, and then you are able then to retain some for business investment going forward, as well as make a strong return like we did at 85% payout to our shareholders. So it's really, really important for us to really look at that perspective.
All right. Two final questions. One is that StanChart is very big on cross-border, and we're in an environment where we are seeing tariff escalation following the resumption of office by Donald Trump. I'm wondering how you see this playing out and whether you see any substantial risks in 25.
From where we sit is we're helping clients in terms of when you talk about the tariffs and the impact, there could be disruption of the supply routes, but we are there to help the clients in move into whether it's new supply routes or in move into new manufacturing centers or going to expand depending on where they are. That is, as I say, that's our sweet spot. If we see, like, for instance, what does it mean? For instance, if there's disruption in the tariffs and probably a certain market is blocked from exporting goods into the US, those goods still have to be consumed. Yeah, because the American consumer is still going to consume those goods. So the next question is, where will those goods come from? And that's how we help, because we facilitate trade. We facilitate trade. So as we focus on cross-border, we're a trade bank. That's how we facilitate it. We are not in the front of the tariff being imposed. Is not being imposed on the bank. It's being imposed on certain markets. And when there are new supply routes happening, then it's something that we can do. We can play very well. I can give an example out of Asia, when we saw after COVID that there was gradual manufacturing. China started looking for new manufacturing hubs outside of China. A market like Vietnam really benefited. We have a presence in Vietnam, and we were there to be able to benefit from that as well. So this helps us in a way. It helps us because we are where things are happening, the world's most dynamic markets. We are in those markets, and we can play to our strengths by being present in those markets.
We've been having a conversation with the top leadership of Standard Chartered Bank on the back of their FY24 earnings. That is CEO Kariuki Ngari and the CFO Chemutai Mugo, unpacking a raft of issues, including the dividend, the income statement, the balance sheet, and how it's looking, and how the opportunity for F25 will be looking like. We shall continue updating you on any developments in the banking space. Stay tuned.